How the Federal Reserve's interest rate decisions impact the stock market. The Federal Reserve is the central bank of the United States, and it plays a crucial role in setting monetary policy. One of the most important tools the Fed has at its disposal is the ability to set interest rates. Changes in interest rates can have a significant impact on the economy and the stock market. In this video, we will discuss the decisions by the Federal Reserve to keep raising interest rates and how it impacts the stock market. The Fed is responsible for implementing monetary policy in the United States. This involves managing the supply of money and credit in the economy. One of the main tools the Fed has for accomplishing this task is its ability to set interest rates. Depository funds, such as banks and credit unions, are required to meet reserve requirements. This refers to the amount of funds that they are required to hold in reserve, either in the form of vault cash or deposits at a Federal Reserve Bank at the end of every single day. Failure to meet the reserve requirements can lead to penalties and fines from the Fed. However, if a bank is running low on reserves, it can borrow money from another bank. The interest rate that applies is known as the federal funds rate. The federal funds rate is set by the Federal Open Market Committee, also known as the FOMC, which is a group of policymakers within the Federal Reserve System. During the COVID-19 pandemic, the Federal Reserve made several significant changes to interest rates in order to support the economy and financial markets. In March 2020, the Fed quickly lowered interest rates to near zero in response to the economic fallout caused by the pandemic. Specifically, the Fed cut the federal funds rate to a target range of 0 to 0.25% in two emergency meetings that were held on March 3rd and March 15th, 2020. This move was made in an effort to help stabilize financial markets, support economic activity, and promote job growth. In addition to lowering interest rates, the Fed also implemented several other measures to help support the economy during the pandemic. For example, it implemented a massive program of quantitative easing, in which it purchased large quantities of government and mortgage-backed securities in order to inject liquidity into the financial system and lower longer-term interest rates. While quantitative easing can be an effective tool for supporting the economy during times of crisis, there are also potential negative impacts associated with this policy. One potential negative impact of quantitative easing is the risk of inflation. By injecting large amounts of liquidity into the financial system, the Fed can increase the supply of money in the economy, which in turn leads to higher prices and inflation. If inflation becomes too high, it can erode the purchasing power of consumers and undermine economic growth. Another potential negative impact of quantitative easing is the risk of asset bubbles. When the Fed purchases large amounts of securities through quantitative easing, it can create a surge in demand for these assets, which then drives up prices and creates an asset bubble. This is exactly what happened after the COVID-19 pandemic. Due to the Fed's monetary policy, stock prices skyrocketed and inflation increased. In fact, in June 2022, inflation reached a 40-year high of 9.1%. To tackle inflation, the Fed embarked on a path of quantitative tightening, which is the opposite of quantitative easing. In March 2022, the FOMC enacted the first rate hike. The aim was to make it more expensive for banks to borrow money overnight. Banks then pass on these higher borrowing costs to consumers and businesses in the form of higher interest rates on loans and credit cards. This makes it more difficult for consumers and businesses to borrow money, which in turn slows down economic growth. Therefore, by raising interest rates, the Fed can reduce the amount of money in circulation, which in turn reduces inflation and stabilizes prices. Rising interest rates also have a significant impact on the stock market. In general, higher interest rates make stocks less attractive to investors, as they can earn higher returns from fixed income investments such as bonds. This leads to a decline in stock prices. However, this is not the only reason why stock prices fall. High inflation causes consumers to spend less. This directly impacts corporate profits, and this is known as earnings contraction. When a company's earnings contract, it can lead to a decline in the company's stock price, as investors may become concerned about the company's ability to generate future profits. This can also lead to decreased investment in the company and a reduction in shareholder value. This was evident in 2022, and it led to the stock market crash that saw the S&P 500 and the Nasdaq drop by 20% and 33% respectively. However, the impact of rising interest rates on the stock market can vary depending on several factors, including the overall state of the economy, the level of inflation, and the performance of individual companies. Over the last year, the Fed has raised interest rates 8 times. The most recent rate hike of 25 basis points occurred in March 2023. However, interest rates went up by 75 basis points 4 times in a row in 2022. One major problem with raising interest rates is that the probability of a recession increases. Despite the aggressive rate rises, Federal Reserve Chairman Jerome Powell has been hoping for a soft landing. An economic soft landing refers to a situation where an economy gradually slows down its growth rate and returns to a sustainable level without experiencing a sharp decline or recession. A soft landing is seen as a desirable outcome because it allows the economy to adjust to a more sustainable level without the negative consequences of a recession, such as job losses and decreased consumer confidence. In a soft landing, economic growth may slow down, but it remains positive, and the economy avoids a significant downturn. Soft landings are often difficult to achieve because it can be challenging to predict the exact timing and magnitude of the measures that need to be taken to prevent overheating. In some cases, efforts to achieve a soft landing can result in an overcorrection that leads to a recession or downturn. At present, economists predict a 60% chance of a recession at some point in 2023. Even former Federal Reserve Chairman Alan Greenspan has weighed in, stating that a recession is the most likely outcome given the current economic trajectory. Jerome Powell has repeatedly stated that the aim is to get inflation back down to 2% over the long run. It is felt that this level of inflation is most consistent with maximum employment and price stability. The U.S. has faced worse times in the past. Inflation surged to great heights in the 1970s. Paul Volcker, who became the Federal Reserve Chairman in 1979, is widely credited with successfully tackling inflation in the U.S. during the 1980s. He aggressively tightened monetary policy by raising interest rates drastically to fight double-digit inflation. The federal funds rate peaked at 20%. In doing so, the U.S. economy entered 2 massive but brief recessions. Inflation was successfully brought down, and by the end of the 1980s, the economy was booming again. However, right now, the Fed will try its best to find a balance between inflation and economic growth so that a deep recession can be avoided. Do you think the Fed will achieve a soft landing? Let us know what you think in the comments section. And if you feel we've earned it, consider subscribing to our channel. At Swing Traders Daily, our aim is to turn you into a successful swing trader. Thanks for watching, and see you soon for another video.